I always tell you financial risk, anytime you hear financial risk, think of market risk, think of liquidity risk, think of credit risk. Those are popular financial risks. However, in this paper, when we're talking of financial risk, our focus in this particular topic is a market risk, which means we are looking at changes in three things and how do they affect us. So we're saying these are the possibility of losing money. Remember, that's why it's a risk. Possibility of losing money as a result of changes in price of commodity, FX rates, or interest rate. When any of these three changes, there's a possibility of losing money. And because of that, we need to treat that possibility. We need to minimize our exposure. We need to manage it. And how do we manage it? How do we manage it? How do we manage this guy? Yeah. All these three guys, how do we manage them? What do we need to do? Two methods I'm going to be talking about. The first one is the value at risk, which we call VAR. Please, for the football lovers, this is not video assistant referee. It's VAR as a VAR, value at risk. And what is value at risk? This is just simply telling you your maximum expected loss. However, not with certainty, with some probability. So, once the probability is just a chance, it's not certainty. However, you want the chance that is quite high, like possibility that is quite high. So, usually we use high confidence level. So, I would say, anytime you hear value at risk, think of maximum expected loss. At a particular confidence level, that's a probability. And also, not forever, it has to be for a period of time. So you need to have a period, maybe 1 year or 2 years. Yeah. So this is about time. This is about probability. And this is about value, amount. So see, these three things must be present in your VAR. So take for instance, if I say my VAR at 90% confidence is equals to 5 million. And let's say my portfolio, which means my investment, is valued at 50 million. Because you need to know how to interpret VAR. It's very, very important. What I am saying here is that the maximum loss is 5 million at 90% confidence level. That's one way to see it. If you understood what I've said properly, you also agree with me that another way to see it is to say that there is only 10% chance of making loss above 5 million. I'm sure you agree with that, because some of your probability must be equals to the Sum of probability of all your outcomes must be equals to 1. And that's why these are saying the same thing. Another way to say it, you might also say it like you only have 10% chance of losing your entire portfolio. And there's a 90% chance that your portfolio will always have a minimum value of 10 million. Because if you cannot lose more than 5 million, then you are guaranteed 10 million at 90% confidence level. So think about it, and you can play around your interpretations, but it's very important for you to understand that interpretation. Yeah. But remember, this is at what period? We always need to put a period. So for 1 year. So in a year, you can't lose more than 5 million. And there's a formula for it, because you might be asked to calculate it or you might need to calculate it. Yeah. If you're managing a portfolio risk using VAR, you need to know the VAR of that portfolio. And that annual VAR is equals to your confidence interval value multiplied by standard deviation. This confidence interval value will be given. It's a value similar to Z-score that you have to pick from a table under the confidence level. Just the same way you are using present value table, that you go to present value table, look at a number, at a percentage, at a year. But this time around, you won't have to pick it yourself. The question, the exams will have stated it for you. So just for you to pick the value, multiply by standard deviation. The worst case they can do is to give you standard deviation in variance. Then you know you have to calculate the square root of variance to get standard deviation. And this standard deviation will always be in value amount. And I'm going to solve a question on it later. Right. And confidence level also is going to be a value that will be given to you. Yeah, but that is annual VAR. But most times, remember, we're talking about investment appraiser, where we have projects lasting as long as 2, 3, 4, 5, 6, 7 years. How do you calculate VAR? So for projects, please take note. The formula is slightly advanced. So if it's a project you are doing, the VAR formula is different. In that case, you need to multiply the annual VAR that you have by the square root of the number of years of the project. So take, for instance, if I give you a quick warm-up to say confidence interval value is 1.25. Standard deviation is $6 million. And the project tenure is over 3 years. It means the project VAR is simply equals to 1.25 times 6 million. This is annual VAR. Then I need to multiply by the square root of 3. And if you do that, you realize that your project VAR is $13 million about. And I hope this is making so much sense to you, because it's extremely important that you are able to break down your VAR into your interpretation. So what we're saying is this 30 million is the maximum loss that project can suffer at a confidence level that gives this 1.25. Let's say if it was 90%. Remember, the question was stated for you. If it's 95%, you will say it. And that is quick one on VAR, value at risk. The other method that you will use to manage financial risk, remember where we're coming from now, is how you manage these risks. Because this next one is now where we're going to be spending a lot of time, and that is talking about hedging using derivatives. This is a popular benefit of derivatives. Apart from trading, speculations, and all of that, derivatives are extremely useful in hedging. And what is hedging? You know, hedging just means you are minimizing your risk. So we're going to be using derivatives to manage price risk, FX risk, and interest rate risk. because we have said that changes in any of these can expose us to losing money, and we want to minimize that risk as much as possible. So for price, I'm just going to just explain it briefly because it's not big in your syllabus, but you still need to know it's easy. What you're saying is changing price might affect your bottom line. So if you're selling, you want the price to be as high as much as possible so that you can make money. And if you're buying, you want to buy as cheap as much as possible. So if you want to buy and price is going up, then that's a risk for you. So you want to minimize that. What can you do? You're always going to fix the price. That's a popular way. So for this one, is that you're always using forward or you're using futures to fix the price? Yeah, forward we've dealt with in FM. So I'm not even talking about forward here. So I'll just stay on futures. So I'll introduce you to futures now. So let's talk about futures. Futures. Futures is very similar to forward actually. But like I always say, the difference is just the fact that it is regulated. That is the big difference. The process also slightly different because it's regulated, right? But the regulation is what makes it so different, which means that you cannot dictate to the market the sizes. Market will fix the price. So market will fix the price. Likewise, the chunks you can buy in terms of quantity, market will do the same thing. So market will say futures are available in quantity of 10, in 20, in 50, in 1,000. So if you want to hedge 15,900, you won't find that on the market. You need to buy 1,500 if one quantity is 100. So you need to play with what is available in the market, which means you're always most likely going to have some exposures that you are not able to hedge because you couldn't get the right quantity in the market. You leave those ones. Yeah. Likewise, market will fix the dates. So you can't say your transaction is happening on May 13 and you want a future that will expire exactly on May 13. You are not likely going to find, because usually there are quarterly futures, maybe March future, June future, September future, and there's always a standard date, I think third Friday of every month, when those futures expires on their day. So if there's no April future on the market and you have a contract that expires in April, please listen. What you must always do is you must always buy future expiring immediately after your transaction date. Buy futures expiring immediately. The closest expiry after, please, must be after your transaction date. And you'll see why as we move on. After your transaction date. So if you have an April transaction and you have a future ending June and September. So if your transaction is April and your future, you have two options. You must go for the earliest one after, and that is June. So take for instance, let's even say you have June, you have March. Yeah. You can't go for March. You can't go for September. March is earlier than your transaction date. September is too far because you have June available. So you do June futures. Please go with me gradually as I'm breaking it down. Yeah, so price is fixed, quantity is fixed, dates are fixed because they are regulated. Yeah. And you can sell or buy a future. You can do both. It all depends on your situation. Imagine if you have gold that you want to sell. Because you want to sell gold, you want to sell at our price as much as possible. So you sell future on gold. So that you know that you already sold it now. Something you're supposed to sell in the future, you have sold it now. That is what it means. That's how you take your position. If you're going to buy gold in the future, you don't know what the price will change to from now to that future. So what you would do is to buy it now. So you buy future. So once you buy futures, then you know that you are sorted. Whatever happens between now and the real transaction date, you are not going to be worried because you have taken a position now. So if you make loss on that futures, you're definitely going to make gain on the real transactions, and you will see how it works. Just follow me gradually because I'm still going to solve questions as well. Yeah. Another concept that you need to know is the concept of basis in futures. Basis. This is not the basis point that you probably have been hearing before. Basis is a figure, is a risk management tool. Yeah, that used to calculate profit. And this is simply equals to, how do you calculate it? It's just any day you want to calculate it, ask yourself, what is the spot price on that day? When you know the spot price, then ask yourself, the future, what is the price of that future on that day as well? So the spot price minus the future price is your basis. And please note that this basis is expected to be zero on maturity. So this is expected to reduce to zero on the expiry date of the futures. So take for instance, if we say today we want to buy futures, and futures is trading at $100 on gold, then we ask, what is the spot price today? Maybe spot price is $113. What we're saying is that today, so this is 3-month futures. Today, up to 3 months, we know the spot price is 113 and the future price is 100. It means that we have a basis of $13. So what we're saying right now is to say that this $13 will reduce to zero over 3 months. That's what we are saying. And we'll usually take an assumption that it will be evenly reduced. So which means we can actually divide 13 by 3. And that's about 4.3 thereabout. So we know that if we divide this into 3 months, we expect about 4.3 reduction in basis up to zero. So that if we pick today at 1 month's time, and we say what is spot price in 1 month, and how is this future trading now? So if spot price has changed to maybe 111, then we can determine what the future price should be trading at. Because we know that on this date, our basis should be 13 minus 4.3 already. That's what we are saying. And that is why people use this understanding to actually predict the future prices. It's a very popular method. And please pay attention as I'm explaining it. Because I know that my future should be trading at a price that is equals to my selling price minus the unexpired basis. So at this point, my unexpired basis will be equals to 13 minus 4.3, because at the first month, it's only 4.3 that should have expired, because I assume that they will go evenly. Yeah, remember I got 4.3 is just dividing the 13 by 3, because the total basis is 13 on day 1, and this is expected to go over 3 months. So each month 4.3 will go, so I will have 8.7 left. So which means if this has to be 8.7, what will be my future price? And that's why we said if spot price is trading at 111, because I will always know what spot price is today, I expect my future to be trading at 102.3. So if future is not trading at 102.3 on that day, then I need to be asking myself, is there a problem of overvaluation or undervaluation by the market? Then with that, I can decide what position I'm going to take. Right. But take note, you just need to know this for now because you might need it to predict your future price. And that's why I quickly explain it to you there. Because of future price prediction. Take note of that. Yeah. So that is it about basis. Another terminology you hear is what you call tick. Yeah, just like a clock ticks. Tick is just simply talking about the minimum price movement. If you look at your wall clock, you can see that the minimum tick is 1 second. The same thing, there's a calibration in the market. So you're talking of minimum price movement. And this might vary for instruments. Yeah, it's a minimum price movement. And what do you use it for? You can use it to measure pure profit or loss. Take for instance, we are saying that tick is 0.01. It means that you can't have a price of 2.4341 because this is already 0.0001. If the tick is 0.01, then the prices that you can have will be things like 4.35, 4.24. It has to be in 2 decimal places. If a tick for a product is 1, then you can't have price of 2.4, 3.6. No. It means that prices can only be 2, 4, 6, 8. That is what tick is just all talking about. It's about the minimum movement in price. Yeah. And one thing you also need to know under features, when you use features, is that it's mostly not going to give you a perfect edge. Which means you won't be able to minimize your risk to 0, but you'll be able to reduce it. And why? There are 2 major reasons. Because number 1, there's a basis risk. And what is this basis risk? The basis risk is just that these assumptions will fail. Which means our basis might not turn to exactly 0 on expiry. Normally, you expect it to be 0 on expiry because by then you expect that the future prediction should be the same as the spot because we are already now at the end. Remember, on this date, we are trying to predict what the price will be in 3 months. That's what the future is talking about. And as you move closer to the expiry date, you start having better understanding, real information, real data. Reality is getting closer. You keep adjusting your prediction, and that's why the price of your future will be moving towards the spot price as it approaches its expiry. And by the time it gets to its expiry date here, what else are you looking for? You expect that to be exactly the same as the spot price. Because how can you predict something different when you're already in today? You already know the price. However, there is still a risk that there might be minor differences. Yeah. And that is why it's quite important to know your basis and how it works properly. The other reason why you might not have a perfect edge with future is what I've explained before, which is the contract size. Not equal to commercial price. And you know why? I've explained that before. Your commercial quantity, which is in your contract, is your real transaction. And that can be any figure. The contract size cannot be any figure because this one is regulated by the market. This is your future. This is your transaction. Your transaction can be anything. This one cannot be anything. The futures contract size cannot be anything. Your transaction contract size can be anything. But futures is regulated. Futures is sold, let's say in 10, if it's sold in 10,000, and you have a transaction of 223,000, it means that you can only buy 2 futures, and that means 3,000 will be unhedged. So that is the exposure, and that will not be a perfect hedge because you still have a part of your transaction that has not been hedged. Very important. Stay on with me. Before I go into calculation, I need to also speak about how credit risk is being managed in this feature, because it's another benefit you get from using feature. Credit risk is better taken care of. In forward, yes, there's an obligation to settle the transaction. However, people can still behave illegally and try to disappear. You go into a transaction with someone in the UK, London, and before you know it, the guy has disappeared and now it's Australia or in New Zealand. You can't even find his location. How do you get your money back? You struggle. Even if you go to court, where do you want to find him? That is forward. For future, it's different. Future takes care of that credit risk, that default risk, in a different way. And the way futures manages that risk is through the margin system. So I'm going to be explaining how margin system works in your futures arrangement. So what this is saying is that on day one, remember, futures is regulated by the market. So you might not even know your counterparty, because it's like a bank that is collecting money from you and giving loan to another person. You have deposits, another person has the loan, but you don't know who has the loan. But you know that the bank is responsible for making sure that your money is secured and you are able to access it anytime you need it. So, which means on day one, when you buy futures, yes, you buy future on day one, or you sell futures on day one. What happens? Regulator will ask for initial margin. Initial margin is a deposit, it's a money deposit. Usually at a particular percentage of the contract, which the regulator will state. So they will say, bring $10 million, for instance, as your initial margin. And what is that for? That is used to cover any future loss. So if you are making losses, your initial margin will start to deplete, because after day one, there will be a mark to market. So that will determine whether you are making losses as the contract is aging or you are making profit. So the first one is, remember, they will ask you to bring initial margin. Then they will communicate, regulator will communicate, the clearinghouse. That's the regulator managing the contract. Will communicate a value for your information. What the value is called the maintenance margin. They communicate the value of maintenance margin amount. This maintenance margin is just like your buffer inventory that you learn in inventory management, which is a minimum level. So this is just a minimum level of maintenance, minimum level of initial maintenance, initial margin, sorry. So minimum level of your margin balance before you'll be asked to bring more money. So that is what the maintenance margin is all about. It's just like your buffer. It's like a level that is being monitored, because if you go below that level, you'll be asked to bring money. And once that, so after day one, remember day one, You have deposited, so this is a deposit, deposited money, and they've told you what your maintenance margin amount will be, which is the level you need to be watching to make sure that you never have a margin balance below. After day one, there will be daily mark to market, which is valuation of your investment, of your contract. There will be mark to market, where the market will have started moving with the future prices changing, spot price changing. This one we have to check whether you are making profit or loss. If you are making loss, your margin balance will reduce. If you are making profit, it will go up. So if you are unlucky that your margin balance goes below your maintenance margin, so please take note. If you've made so much loss and your margin balance goes below the maintenance level, then this will result into a margin call, which means the clearinghouse will call you to bring more money. So they will ask you to deposit more funds to a level above your maintenance margin. And if you don't pay, if you default, so if you ignore the call, what happens? You know you're in trouble because the contract will be closed. Because they will not wait until you lose all your deposit and you run away and they can't pay your counterparty. So once you fail one call, the contract will be closed. And with that, at that point, they have enough money to settle the counterparty. Remember, your loss is profit to the other person. So that person needs to get his money because he has made profit. And the clearinghouse will never wait until the full margin is depleted before they close the contract. But if you top up as you are expected to top up, then the contract stays alive until expiry. And on expiry date, please note this, very important now. On expiry date, you can close a future either by delivering the asset, that is the obligation, or you take opposite position. Which is a popular one that you will see in reality. And that is the approach we're going to be using in this paper. Okay? So, in summary, what we're saying is for futures, 3 transactions are involved. Yeah? Anytime you're solving a problem in futures, think of 3 transactions that you must compute, and that's how we're going to be solving questions going forward. For you to do your calculations, please, this is for your calculations, because without the 3 transactions, your calculations will not be correct. The first one is your day 1 future transaction, so which means either you are buying or you are selling future on day 1. Then on expiry dates, 2 things will happen. On expiry date, 2 transactions will happen. The first thing that will happen is the fact that you need to close the future transaction. How do you close it? By doing the opposite. You have to take the opposite of your previous position. So if you have bought on day 1, then you have to sell future. But if you sold in day 1, then you have to buy futures. That is how you close the transaction. But it does not end there. The third part is you still need to execute the hedged transaction. The transaction that you're trying to protect, you need to still do it at the spot rate, at spot price. Remember, all of this will be happen at the future price, the futures price. Please, and when I'm talking of future price, I'm not talking about price in the future. I'm talking of price of futures, because that can be a confusing part. Please clear that right. And we're going to be going into questions in my subsequent videos.